Most people think paying cash for a car is the smart financial move, but dividend investors know something different. While everyone else is emptying their savings accounts for a $50,000 vehicle, we're using a strategy that actually makes us money while driving that same car. Today, I'm revealing the exact method that lets you get the car you want while your money keeps working for you in dividend-paying stocks. By the end of this video, you'll understand why cash buyers are leaving thousands on the table. Let me introduce you to Sarah. She's 32, works in marketing, and just got promoted with a $15,000 raise. Her 10-year-old Honda finally died, and she needs reliable transportation. Sarah has $50,000 sitting in her savings account, earning practically nothing. The conventional wisdom says she should buy that car outright and avoid debt. But Sarah discovered something that changed everything about how she thinks about major purchases. Instead of writing a check for $50,000, Sarah kept that money invested in dividend-paying stocks and took out a car loan at 4.5% interest. Sounds backwards, right? Here's what happened next. Her dividend portfolio generates 8% annually. While she's paying 4.5% on her car loan, her $50,000 is earning her $4,000 per year in dividends alone. That's a net gain of 3.5%, or about $1,750 annually that she wouldn't have if she'd paid cash. If you want to master these counterintuitive wealth-building strategies that actually put money in your pocket instead of taking it out, subscribe now. I release new videos every Tuesday and Friday showing you exactly how dividend investors think differently about money and how these shifts in thinking can accelerate your path to financial independence by years, not months. But Sarah's story gets even better, and what I'm about to show you will completely flip your understanding of how the wealthy actually handle major purchases. There's a hidden wealth transfer happening every day that most people never see. Here's the foundational principle that dividend investors understand. Money has an opportunity cost. Every dollar you spend is a dollar that can't be invested in working for you. When you pay cash for a car, you're not just buying transportation. You're giving up years of compound growth and dividend income. Let's break down the real mathematics. Sarah's $50,000 invested in a diversified dividend portfolio, earning 8% annually, doesn't just earn $4,000 in year one. In year two, if she reinvests those dividends, she's earning returns on $54,000. By year five, assuming she reinvests her dividends, her original $50,000 has grown to approximately $73,000, generating nearly $6,000 in annual dividend income. Meanwhile, her car loan payment is fixed. Let's say she's paying $600 monthly for 7 years. That's a total of $50,400 over the life of the loan. But remember, she's earning dividend income the entire time. Over those 7 years, her dividend income more than covers her car payments, and she still owns a growing investment portfolio. Compare this to paying cash. The cash buyer has a car worth maybe $25,000 after 7 years, while Sarah has a car worth the same amount plus a dividend portfolio worth over $70,000. The difference is staggering, but this strategy goes deeper than simple mathematics. Dividend investors think about liquidity differently. When you tie up $50,000 in a depreciating asset like a car, that money becomes illiquid. You can't access it without selling the car. Your $50,000 is essentially frozen until you're ready to trade down or sell. Keeping that money in dividend stocks maintains your financial flexibility. If an emergency arises, you can sell shares if needed. If a better investment opportunity appears, you have capital available. If you lose your job, you have dividend income still flowing in to help cover expenses, including that car payment. This is where dividend investors separate themselves from everyone else. They understand that cash flow trumps ownership in wealth building. The goal isn't to own everything outright. The goal is to maximize the productive use of every dollar. Let's look at another example. Mike is 55 and considering early retirement. He needs a new truck for his consulting business. The truck costs $45,000. Mike has the cash to buy it outright, but he understands the opportunity cost calculation. Instead, Mike takes a 5-year loan at 5% interest. His monthly payment is $849. He keeps his $45,000 invested in dividend aristocrats, companies that have increased their dividends for 25 consecutive years or more. These stocks typically yield between 2 and 4%, but grow their dividends annually. Mike's dividend income from that $45,000 starts at about $1,800 annually, or $150 monthly. But here's the key. Those dividends grow every year. By year 5, his annual dividend income has grown to approximately $2,500, or over $200 monthly. His car payment stays fixed at $849 monthly, but his dividend income keeps growing. Plus, the principal value of his investments grows over time. After 5 years, Mike's original $45,000 investment has grown in value while also providing increasing income. The cash buyer has a truck and no investments. Mike has the same truck plus a growing investment portfolio generating increasing dividend income. Which position would you rather be in? Now let's address the psychological barriers that keep most people from using this strategy. The biggest objection I hear is about debt. People have been conditioned to believe all debt is bad debt, but dividend investors understand the difference between good debt and bad debt. Bad debt is high-interest debt used for consumption. Credit card debt at 20% interest to buy clothes or vacation expenses. Good debt is low-interest debt that allows you to maintain or increase your wealth-building capacity. A car loan at 4 to 6% interest that allows you to keep money invested earning 8 to 10% is good debt. It's leverage that works in your favor. The key is ensuring your investment returns consistently exceed your borrowing costs by a comfortable margin. Another common concern is investment risk. What if the stock market crashes right after you buy the car? This is where dividend investing shows its strength. Quality dividend stocks from established companies don't disappear overnight. Even during market downturns, many dividend companies continue paying their dividends. During the 2008 financial crisis, about 20% of dividend-paying companies cut their dividends. 80% maintained or even increased their payments. Compare that to the housing market or growth stocks that lost 50 to 80% of their value. The key is choosing quality dividend stocks. Companies like Johnson & Johnson, Coca-Cola, Procter & Gamble, and Microsoft have paid dividends through multiple recessions and market crashes. These aren't speculative investments. They're ownership stakes in profitable businesses that generate cash flow regardless of market sentiment. Here's where most people get stuck, and it's probably the exact thought going through your mind right now. But everything I've shown you so far is just the foundation. The really sophisticated dividend investors take this strategy 3 levels deeper, and that's where the wealth building accelerates dramatically. The advanced strategy involves what I call payment arbitrage. Instead of just comparing investment returns to loan interest rates, sophisticated dividend investors structure their loans to maximize tax advantages while minimizing cash flow impact. Here's how it works. Instead of taking a traditional 5 or 7-year car loan, they might choose a longer-term loan with lower monthly payments. This frees up more cash flow to invest in dividend stocks. The additional dividend income often exceeds the extra interest paid over the longer term. Let's say you're choosing between a 5-year loan at 5% with payments of $943 monthly or a 7-year loan at 5.5% with payments of $714 monthly. The shorter loan saves money on total interest but ties up an USD additional $229 monthly in car payments. A dividend investor might choose the longer loan and invest that extra $229 monthly in dividend stocks. Over 7 years, investing that extra monthly cash flow at 8% returns generates approximately $25,000 in additional wealth, far exceeding the extra interest paid on the longer loan. This is the kind of optimization that creates wealth over time. While most people focus on minimizing interest payments, dividend investors focus on maximizing total wealth creation. It's a completely different framework for making financial decisions. The tax implications add another layer of sophistication. In many cases, car loan interest isn't tax deductible for personal vehicles, but dividend income receives favorable tax treatment. Qualified dividends are typically taxed at capital gains rates, which are lower than ordinary income tax rates for most investors. This means your investment returns keep more of their value after taxes, while your car loan payments are made with after-tax dollars. The effective arbitrage spread becomes even wider when you account for taxes. But here's where it gets really interesting for business owners or self-employed individuals. If you use your vehicle for business purposes, a portion of your car loan interest becomes tax deductible. This can reduce the effective interest rate on your loan while your dividend income maintains its favorable tax treatment. Some business owners structure their car purchases through their business entity, allowing them to deduct the full loan interest while maintaining their personal investment portfolios. This creates a powerful combination of tax efficiency and wealth building that cash buyers completely miss. The leasing angle provides another sophisticated option. Dividend investors often prefer leasing luxury vehicles instead of buying them. Here's why this makes sense from a cash flow perspective. Leasing typically requires less money upfront and lower monthly payments compared to financing the full purchase price. This frees up even more capital for dividend investing. Instead of tying up $50,000 in a depreciating asset, you might lease the same car for $500 monthly while keeping the full $50,000 invested. Your dividend income from that $50,000 at 8% annually generates $4,000, or about $330 monthly. Your net cost for the car becomes only $170 monthly, while you maintain ownership of a growing investment portfolio. When the lease ends, you return the car and have no maintenance or repair concerns. Your investment portfolio has grown over the lease term. You can lease another new car and repeat the process, always driving newer, more reliable vehicles while your investments compound. This strategy works particularly well for luxury vehicles that depreciate rapidly. Instead of owning a $70,000 luxury car that's worth $35,000 after 3 years, you lease it for 3 years while your $70,000 grows to over $88,000 in dividend investments. The practical implementation requires careful attention to loan terms and investment selection. Not all car loans are created equal, and not all dividend stocks provide the returns needed to make this strategy profitable. For car loans, focus on getting the lowest possible interest rate through credit unions, banks, or manufacturer financing. Rates below 5% make this strategy very attractive. Rates above 7% require higher investment returns to generate positive arbitrage. Your credit score becomes crucial. The difference between a 4% loan and a 6% loan is significant over the loan term. Before implementing this strategy, ensure your credit score is optimized. Pay down credit card balances, correct any errors on your credit report, and consider timing your car purchase when your credit profile is strongest. For dividend stock selection, focus on quality over yield. A 6% dividend from a shaky company isn't better than a 3% dividend from a stable company that grows its dividend annually. Look for companies with long dividend payment histories, reasonable payout ratios, and growing earnings. Dividend aristocrats and dividend kings provide excellent starting points. These companies have proven their ability to maintain and grow dividends through various economic cycles. Building a diversified portfolio across multiple sectors reduces risk while maintaining growth potential. Consider dividend-focused exchange-traded funds for instant diversification. The Vanguard Dividend Appreciation ETF, iShares Select. Dividend ETF and SPDR S&P Dividend ETF provide exposure to hundreds of dividend-paying companies with single purchases. The reinvestment decision becomes critical for long-term success. During the early years of your car loan, consider reinvesting dividends to accelerate portfolio growth. This maximizes the compounding effect and builds wealth faster than taking dividends as cash. As your portfolio grows and your dividend income increases, you might shift toward taking some dividends as cash to help with car payments or other expenses. This provides increasing financial flexibility over time. Timing considerations can enhance results. Car manufacturers often offer special financing promotions with rates below market levels. 0% financing for qualified buyers makes this strategy extremely attractive, as any positive investment return generates pure profit. End of model year sales, dealer incentives, and manufacturer rebates can reduce the amount you need to finance while maintaining the same investment balance. The lower your loan amount relative to your investment portfolio, the more attractive the arbitrage becomes. The exit strategy requires planning from the beginning. When your car loan is paid off, you have several options. You can sell the car and use the proceeds to buy another car with financing, maintaining your investment portfolio. You can keep the car and redirect your former car payments into additional dividend investments. Or you can take some profits from your investment portfolio and buy your next car with a combination of cash and financing. The key is maintaining the discipline to keep your investment portfolio growing rather than cashing it out for lifestyle upgrades. The real wealth building happens when you resist the temptation to spend investment gains and instead allow them to compound over years and decades. This strategy represents a fundamental shift in thinking about major purchases. Instead of asking, how can I minimize this expense? Dividend investors ask, how can I structure this purchase to maximize my wealth building? It's the difference between defensive financial thinking and offensive wealth creation. The results compound over time. The person who pays cash for cars every few years maintains a stable net worth, but builds wealth slowly. The dividend investor who finances cars while building investment portfolios creates accelerating wealth that provides increasing financial freedom. Sarah, who we met at the beginning, is now 3 years into her strategy. Her investment portfolio has grown to over $60,000, while her car loan balance has dropped to $28,000. Her net worth has increased by over $30,000 compared to paying cash, and she's generating increasing dividend income that provides financial security and flexibility. This isn't just about cars, it's about developing an investor mindset that maximizes the productive use of every dollar. Once you understand these principles, you'll start applying them to other major purchases and financial decisions. The wealthy think differently about money and debt. They use leverage strategically to build wealth faster while maintaining liquidity and flexibility. This car financing strategy is one example of how dividend investors optimize every financial decision to accelerate their path to financial independence. If you're ready to take your dividend investing to the next level, you need to see my video on the $1,000 dividend strategy nobody talks about. It reveals another counterintuitive approach that most investors completely miss, and it perfectly complements what we've covered today. Check it out right here on your screen. The combination of these strategies can dramatically accelerate your wealth building timeline.